you are required to determine what we call the carrying amount of an asset and the tax base of an asset. Carrying amount is the book value, and tax base is the amount that is attributable for tax purpose. Therefore, if you want to do deferred tax, we say deferred tax equals to temporal difference times tax rate. Temporal difference times tax rate. Then we said that temporal difference equals to carrying amount minus tax base, carrying amount minus tax base. Therefore, there we are going to determine the temporal difference by getting the carrying amount of an asset minus the tax base. Then we get deferred tax. Therefore, when we look at this question, of May 2017, it says that May 2017, question number 4, May 2017, question number 4, it says like this: Munro Limited, a manufacturing company, provides for a deferred income tax in accordance with IAS 12 income taxes. The following is an extract from the statement of financial position as at 30th April 2017. Now, examiner has given us the balance sheet where we have property, plant and equipment, intangible assets, goodwill, financial assets that are available for sale. Then we have inventories, trade receivables, prepayments, and cash equivalent. Under equity and liabilities, we have share capital there, revaluation reserve, retained profit, non-current liabilities, we have interest-bearing loans, deferred income tax, 1st May 2016, current liabilities, we have trade and other payables, employee benefits, and current income tax. Additional information. The tax base of the assets are as follows: property, plant and equipment, prepayments, interest-bearing loans, financial asset that's available for sale. Number 2, inventories are stated at fair value less cost to sell, which is lower than the original cost due to general provision for price decline of 3.5. Number 3, the intangible assets comprise development cost, which is tax deductible when the amount is paid out. The cost of intangible asset was paid in the year 2014 and is presented net of amortization cost. Number 4, goodwill and employee benefits are tax exempt. Number 5, trade and other payables include a provision for leave allowance of 1.4 million, which is tax deductible on cash basis. Number 6, trade receivables are stated net of general allowance for bad debts at the rate of 5% of the gross receivable. The general allowance is not tax deductible until it becomes specific. Number 7, the building, which is included in property, plant and equipment, was revalued during the year. The increase in value of 3 million does not affect the tax base. Number 8, the tax base of other items is equal to their carrying amount. Number 9, the tax rate applicable is 30% required. Deferred tax balance as at 30th April 2017, 12 marks. Then we have deferred income tax as at 30th April 2017. There we have 2 marks. Therefore, examiner wants us to get what we call deferred tax. Examiner wants us to get what we call deferred tax. In the question of May 2017, examiner wants us to get what we call deferred tax. May 2017, question 4B. We say deferred tax equals to temporal difference times tax rate. Temporal difference times tax rate. temporal difference equals to carrying amount minus tax space. Once I have this, then I cannot miss a mark there. Once I have this, I cannot miss a mark. Therefore, I need the carrying amount, I need the tax space. Therefore, I say here, item, we say item. What will be the carrying amount of this item? What will be the tax base of this item? What will be the temporal difference of this item? Temporal difference of this item. Quickly, I believe you are preparing that shape so that we move fast. If you are doing it faster. Okay, we go to note number 1. Note number 1 says, the tax base of the assets are as follows. Now, in many instances, listen very carefully here. In many instances, once the examiner has given you the balance sheet, once you have the balance sheet, then the value in the balance sheet becomes what we call the book value. The values in the balance sheet becomes what we call the book value. Becomes what we call the book value. What we have in the balance sheet becomes the book value. Therefore, when you go to note number 2, examiner is saying the tax base of the note number 1, sorry, the tax base of the assets are as follows. We have property, plant and equipment, prepayments, interest-bearing loans, financial assets available for sale. Now, when I take my PPE, property, plant and equipment, what is the carrying amount of this item? Carrying amount, I'm going to take it from the balance sheet. Carrying amount from the balance sheet is 14,000. Then what is the tax base? Examiner has been gracious to me. He has given me the tax base as 2,800. Therefore, what is the difference that we call the temporal difference? The difference that we call the temporal difference is 14 minus 28 minus 28, which is 11,200. The difference is 11,200. Therefore, my question is, carrying amount is 14, tax base is 28. Now, this temporal difference, is it taxable or deductible? Of course, this is taxable. This is taxable. That is taxable temporal difference. I go to note to item number 2, prepayment. Prepayment. Prepayment from the balance sheet, examiner has given me the value of prepayment as 32. When you check in the balance sheet, prepayment is 32. What is the tax base? Examiner is telling me the tax base is 1,500. Therefore, what will be the temporal difference? The temporal difference will be 3,200 minus 1,500, which is 1,700. Then I ask myself, is it taxable or deductible? Of course, this one is taxable temporal difference. Why is it taxable? Because the taxman is saying the value of the asset needs to be 1,500, but you are presenting 32. Therefore, you have more future economic benefits. You have more future economic benefits. Of course, I go to item number 3, which is interest-bearing loan. Interest-bearing loan, where from the balance sheet, I have the carrying amount of 16,000. 16,000. Interest-bearing loan is 16,000. What is the tax base? Examiner is telling me the tax base is 17,000. 17,000. Therefore, what is the difference? Of course, it is what? 1,000. Now, when we take on this difference, this is a liability. This interest-bearing loan is a liability. Therefore, according to the taxman, the liability needs to be 1,700. But for me, I'm presenting less liability. Therefore, it means that the company is gaining from this liability. Therefore, of course, this one becomes taxable. It becomes taxable because the liability is reducing. Then the next is a financial asset that is available for sale. Available for sale financial assets. Available for sale financial assets. When I check from the balance sheet, available for sale financial assets, it has 12,000 from the balance sheet under non-current liability. It has 12,000. When I check in the tax base, examiner is saying the tax base is 14,000. 14,000. Then what is the difference? Of course, the difference is 2,000. But the question is this 2,000 taxable or deductible? Now, when we check on this one, according to the taxman, the asset needs to be 14. But for us, we are presenting 12,000, which means ours is less. When our value is less, it means we are making a loss. Therefore, this one becomes deductible temporal difference. It becomes deductible temporal difference. I go to note number 2. Inventories are stated at a fair value less cost to sell, which is lower than the original cost due to the general provision for price decline of 3.5 million. Now, examiner is telling us that we have inventories. I have inventories. I have inventories. I have inventories there. Examiner is telling me that inventories are stated at fair value less cost to sell, which is lower than the original cost due to general provision for price decline. Before even I go there, according to IAS 2 inventories. Let me tell you something before we proceed there. I believe you are listening so that you will not forget these things. When I have inventories, when you have two values, that is a net realizable value and cost of inventory. As an accountant, always you report the lower. Always you report the lower of. For example, I have NRV, net realizable value of my inventory is 2,000. Then the cost of inventory is 3,000, is 300 like that. If as an accountant, I want to report my inventory, I will report the lower. Therefore, as an accountant, you always report 200, which is the lower. You always report the lower. When you have two values of inventory, sometimes examiner in a question, he will give you the fair value, net realizable value was this one. Then you also, the cost was this one. As an accountant, always you report the lower of. Thank you very much for that. Now, examiner here is telling me inventories are stated at fair value less cost to sell, which is the lower than the original cost due to the general provision for price decline of 3.5. Therefore, in the balance sheet, my inventory is 7.5, 7,500, which was the lower of. When I go to the taxman, this is due to general provision. Remember we said, when a current asset is subject to general provision, we discussed this one in detail. I'm just reminding you, if you forgot, that is your own problem. I said, if the asset is subject to general provision, then the tax base will be the gross amount. Therefore, we reported net of 70 net, which is 75. When I go to the tax base, I will add 3,500. I will add 3,500, which will be 11, because we cross up. When you go to our summary, we say you are going to cross up if it is subject to general provision. Therefore, my temporal difference is 35, but deductible. Then we go to the next note. Number 3. The intangible asset comprised development cost, which is tax deductible when the amount is paid out. The cost of intangible asset was paid in the year 2014 and is presented net of amortization cost. Therefore, we have intangible asset. Intangible asset there. On intangible asset, the carrying amount is presented as 4,000. 4,000. And of course, we say that the tax base of an intangible asset, when you go to our summary, remember I'm referring to the summary that we wrote on that day, on Monday. When we go there, we say that if we have intangible asset or development cost, the tax base is always nil. Therefore, this is 4,000. That is 4,000, but it is taxable, taxable, taxable. Then we go to the next note. It says goodwill and employee benefits are tax exempt. If an asset is tax exempt, it means that the carrying amount and the tax base will be the same because there will be no difference in measurement. Therefore, there is no need of including it here. There is no need of including it there because the tax base is same as the carrying amount. Therefore, the temporal difference is nil. If it is tax exempt, it means the taxman has no any rule there, has no any amount that he will attribute to tax there. We go to number 5. Trade and other payables include provision for leave allowance of 1 Kenya shillings 1.4 billion, which is tax deductible on cash basis. Trade and other payables include provision for leave allowance of shillings 1.4 million, which is tax deductible on cash basis. Now, when you go to our summary, listen very carefully and you go to our summary. We say that if any liability is taxable or deductible on settlement or on cash basis, then the tax base is always nil. The tax base is always nil. That is what we say. When you go to that schedule, that one is very clear there. That one is very clear there. Thereby, I have trade payables. I have trade payables, which is a liability. The carrying amount in the balance sheet is 8,000. Is 8,000. And included in this is 1.4 million, which is of leave allowance. Therefore, what will be my tax base? My tax base will be 6,600. Why 6,600? Because I'm taking 8,000 minus 1,400, I get 66, because the tax base of 1.4 is the one that will be nil, not the whole of 8, not the whole of 8, because in 8 we include leave allowance of 1.4, which is tax deductible on cash basis. Therefore, if it is tax deductible on cash basis, then it means the tax base is nil. Therefore, I have here 1,400, which is deductible, which is deductible, which is deductible. 1.4 there, which is deductible. Then number 6, trade receivables are stated at net of general allowance for bad debts at the rate of 5% of the gross receivable. The general allowance is not tax deductible until it becomes specific. Until it becomes specific. Therefore, I have my item as receivable. As receivable. This receivable, examiner has presented it as 6650. 6650, but it is net of general allowance of bad debts. General allowance of bad debts at 5%. Then what will be the tax base? The tax base will be the gross amount. The tax base will be the gross amount. Why is it the gross amount? Because it is subject to general provision. General provision. Therefore, I will say 95% equals to 6650. What about 100%? Therefore, equals to 100 times 6650 divided by 95, because 6650 is just 95. Therefore, thank you very much. Not quitting. Thank you very much. It comes to 7. 7,000 there, 7,000, which is 350, but it is deductible. It is deductible there. It is deductible because it is net of general allowance of 5%. Therefore, 6650 equals to 95%. What about 100? When you cross up the 5%, it comes to which amount? Then number 7, the building which is included in property, plant, and equipment was revalued during the year. The increase in the value of 3 million does not affect the tax base. Therefore, we did revaluation of an asset. We did revaluation of an asset, but the examiner is telling us the revaluation does not affect the tax base. The revaluation does not affect what? The tax base. Therefore, it means after we have determined our deferred tax, then we are going to compute the tax effect on the revaluation surplus. The tax effect on the revaluation surplus, then we take it to deferred tax account. Remember, we stated that when assets are revalued, the deferred tax effect on the revaluation surplus or deficit should be determined and transferred to deferred tax account. When you check to our notes, that item is there. That item is there. That item is there categorically. It is there, very clear, very straight. Therefore, here, you are going to give me the net temporal difference. Net temporal difference, so that we get deferred tax quickly. You take the taxables minus the deductibles. Ten 650. 10,650. That is our net temporal difference. 10,650. Then deferred tax. Deferred tax equals to 10,650 times 30%. Times 30%. 10,650 times 30%. That 195. That 195, that is our deferred tax. That 195 is our deferred tax. Then what I'm putting across is that when you are doing deferred tax, you need the carrying amount of an asset and the tax base of an asset or liability. Now, in deferred tax, we need to discuss what we call the movement in deferred tax. Briefly, let's look at the movement in deferred tax. Movement in deferred tax. Movement in deferred tax. Let's look at the movement in deferred tax, and then we say like this. Deferred tax calculated, deferred tax calculated is always tax at the end of the year, tax liability or asset at the end of the year. At the end of the year. The difference between the opening balance and the closing balance is what will be reported as deferred tax expense or income. What Mwalimu is saying that deferred tax calculated is always tax liability or tax asset at the end of the period. Like here we have calculated that 195, that's tax liability in our balance sheet. The difference between the opening balance and the closing balance, now this will be the closing balance. If the examiner has given us the opening balance, the difference between the two, that movement, the difference between the two is what will make up either tax income or tax expense. Tax income or tax expense. Now let's prepare deferred tax account and see if we have tax income or tax asset. Therefore, let's look at tax effect. First, let's look at tax effect on revaluation. Tax effect on revaluation. Tax effect on revaluation. We have revaluation PPE, which equals to 3 million times 30%, which equals to 900. 900 is the tax effect on revaluation. Tax effect on revaluation. Transfer this tax to deferred tax account. Transfer the tax, revaluation tax, tax on revaluation, transfer the tax on revaluation to tax account, Transfer the revaluation to tax effect on revaluation to tax account. Therefore, let me prepare my tax account. That is called deferred tax account. Balance brought down. When I started the year, did I have any tax in my trial balance? Yes, I had deferred tax in my trial balance of 1,200. When I started the year, I had 1,200. I'm getting it from the balance sheet. Don't ask Mwalimu, where are you getting 1,200? You check in the balance sheet, there is tax effect of 1,200. Then when I'm closing the year, balance brought down, carried down, balance carried down. When I'm closing the year, balance carried down is 31.95. That 195. Balance carried down is 31.95. Then I have tax effect on the revaluation. Revaluation, tax effect on revaluation, that is PPE. I had 900. I transfer it to deferred tax account. Therefore, when I balance this account, I'm going to take 1,200 plus 900, then I compare with 31.95. I'm getting 10.95, but it's falling on credit side. Therefore, this is balancing figure. Tax expense, 10.95. 10.95 is our tax expense. This goes to P and L. P and L. Profit and loss as our tax expense. It goes to profit and loss as tax expense, but this one, what we calculated, goes to the balance sheet as a tax liability. This one goes to the balance sheet as the tax liability, Therefore, that is what we are required to do to get those 14 marks. That is what we are required to do to get 14 marks. And that marks the end of our topic, income taxes. Now we shift our gears to another topic, which is a financial instrument, which is financial asset and financial liabilities. Financial asset and financial liabilities. Financial asset and financial liabilities, that is generally financial instruments. Any question, you just put it in the chat. Don't fear anything. Don't fear anything. Any question, just put it in the chat. Florence will say you have a problem in with the 2015. That question has no problem. They just say maybe there's one or two issues we shall discuss privately. That one I will give you a call, and maybe tomorrow we shall discuss. You tell me where the problem is, because you cannot say the whole question defeated you. Maybe some few items, maybe how you account. Therefore, I will give you a call maybe tomorrow. Then you tell me where exactly is the problem, then we sort it out. I believe that one we shall sort it out because you have attempted it. Because you have attempted that, I will just privately give you a call, then we discuss that. You tell me where the problem is. Therefore, prepare where the problem is in that question. You cannot tell me that the whole question has a problem. Just identify where the problem is. When I call you or when you call me, we discuss it, then we do it. Therefore, that is the end of our topic, income taxes. The end of our topic, income taxes. We go to another topic called financial instruments. Financial instruments. Another topic called financial instruments. IFRS 9, IFRS 9, and I believe you are reading our notes, because these notes that we are doing, like here, we are not writing too much, because I am very sure you have the handout, therefore you already have the notes. That's why we are not writing. Therefore, if you are just listening and you are not reading our notes, I tell you, you will get trouble. You make sure that, like for example, when we are doing this topic, make sure that you also utilize the resources that are available. The resources that are available is our notes that I prepared myself, a summary of what we are going to do. A summary, summarized notes, you get them there. Therefore, make sure that also you are getting time to make your brief notes from that. You make brief notes from that. Now, we want to look at financial instrument, IFRS 9. This is also a very long topic. I believe if we meet tomorrow, we can either, God willing, we can finish it, or if we shall not finish it, we finish it on Monday. But it's a long topic. We need to be very vigilant on it. Now, here we are going to look at financial assets. Financial assets and financial liabilities. And financial liabilities. Financial assets and financial liabilities. Now, let's introduce the concept now. When we say financial instrument, what does it mean? When we talk of financial instruments, what does it mean? Financial instruments, what does it mean? When you talk of financial instruments, what does it mean? I believe in one way or another, you have ever borrowed money. You have ever borrowed money from even a friend or from a bank or somewhere you have borrowed money. Therefore, that borrowing, thank you very much, Florence. You say a loan or a debt, thank you very much. That borrowing is what we are going to say is a financial instrument. Borrowing. What is a financial instrument? Financial instrument is a contract that gives rise to a financial asset of one business entity and a financial liability of another business entity. Remember, if company A goes to borrow from company B, this company A is borrowing from company B. It means that it is creating what we have a financial instrument. To company A, the borrower, this is the borrower, this is the lender, this is the lender. the borrower and the lender. Therefore, in this one, we are having what we call, this one is a financial liability because you are borrowing. You are creating what we call a financial liability. Then this one is a financial asset. A financial asset is an asset because you are investing in someone. You are when you give Mwalimu money and Mwalimu will return it back with maybe some interest, then what does it mean? It means that you are investing so that your money grows. Therefore, that is what we call a financial instrument. Is a contract that will create a financial asset of one business entity and a financial liability to another business entity. Therefore, we have said that we have a financial asset and a financial liability. We need to understand what is a financial asset. What is a financial asset? What is a financial asset? Now, the financial asset can be number one, cash. It can be cash, pesa, cash. Or number two, the right. It can be the right to receive cash. The right to receive cash. The right to receive cash, or equity instrument. Equity instrument of another business entity. What is a financial asset? It is either cash or the right to receive. For example, if you give Mwalimu money and Mwalimu needs to pay back, then it means for you, you have the right to receive money from Mwalimu. That's why we are saying that becomes an asset. You have the right to receive the money from Mwalimu. Therefore, the right to receive cash or equity instrument of another entity. When we talk of equity instrument, this is where companies will be issuing shares to the public or to people. When companies issue shares, they are also creating a contract, because if you are giving a company money, then the company will call it, this is equity shares. But for you who is paying the money, you call it equity investment. But the company is giving you shares, it is reporting as equity. It will be paying dividend on it, therefore it becomes a liability. But they don't call it a liability, they call it equity. I will explain why is it equity. Then we go to what is a financial liability. What is a financial liability? This is the obligation. Obligation to deliver cash or equity instrument to another entity. The obligation to deliver. Obligation to do what? To deliver cash or equity instrument to another entity. Like, for example, I have said the company can issue shares. If you issue shares, I give you my money, then you have the obligation to give me that equity instrument. That is the contract. Equity instrument is the contract. Therefore, that is what we are saying. It's a financial liability. Then we go to what we call recognition of the financial instrument. Recognition of the financial instrument or the financial asset or the financial liability. Recognition, what does recognition mean? Recognition means, when should we start reporting this financial instrument or financial asset in our books? That is recognition. Recognition means, when are we going to start recognizing this financial instrument in our books? That is what we call recognition. Now, Financial assets are recognized in the financial statement when the entity becomes party. Entity becomes party to the contract. Becomes party to the contract. Recognition. Financial assets are recognized in the financial statement when the entity becomes party to the contract. Therefore, the moment you become party to the contract, and how do you become party to the contract? Like, for example, you have announced that you want to issue shares. Then I come and I register, you give me the certificate, I give you money, then I have become party to what? To the contract. You go to the bank to take a loan, you fill all the forms, then the money is credited to your account. The moment you have filled all the forms, then you have become party to the contract. Now you are required to start recognizing that financial instrument in your books. That financial instrument in your books. Then we look at something else called the recognition of financial assets and financial liabilities. The recognition of these financial assets and financial what? Liabilities. The recognition. What does the recognition mean? When to remove this financial asset or financial liability in your books. The recognition means when should you remove it in the books. Number one here, financial assets are recognized when the right to the when the entity transfers substantially all the rewards and the risks to another party, to another entity or another party. Therefore, the moment you transfer the risks and the rewards from this instrument to another party, then you are required to remove it in your financial statement, or you can also recognize when the contractual right to the cash flow expires. The contractual right to the cash flow expires, and it can expire due to passage of time. It can expire due to passage of time. When the cash flow expires, the right to the cash flow expires, then you can recognize, or when you substantially transfer all the rewards and risks to another entity, then you recognize, you remove it in your financial statement. When you go to our notes, you will read more on the rules of the recognition. It is there, very straightforward. You will read on it, the rules on the recognition, Now we are moving on well. Now we go to another critical part where we call classification and measurement. Classification and measurement. Classification and measurement. This one, let me do a break of 5 minutes. When we come back, we look at the classification and measurement of financial assets. Let's have a break of 5 minutes. A break of 5 minutes. When we come back, we look at. Okay, let's begin on classification. Now we know what is a financial asset, what's a financial liability. Now let's go to classification and measurement. Classification and measurement. When we say classification and measurement, how are we going to report these financial assets and financial liabilities in our books of account, in our books? For example, I'm investing in a treasury bond. I'm investing in equity shares as a company. I'm buying shares in other companies. How am I going to recognize them in my books? Is it as a current asset? Is it as a non-current asset? Or is it as a liability? That is what we are saying, classification and measurement. I believe you are together, we are together there. Therefore, let's begin like this. Financial assets are classified based on two things. Financial assets are classified based on two things. Number one, we are going to call it entities business model. Business model. We are going to classify them based on one, the entities business model. Number two, a contractual cash flow characteristics based on the contractual cash flow characteristics. For me to classify these financial assets, I'm going to consider two things. I'm going to consider two things. This is a financial asset. For me to classify it or to measure it in my books, I'm going to consider two things. Number one, we call it the entities business model for managing this financial asset. Number two, the contractual cash flow characteristics that comes from this financial instrument. Now, what is the entities business model? The business model will show us why are we investing in this instrument. Listen very carefully. Why are we investing in this instrument? That is the business model. I'm investing in this asset for speculation purpose, that is for trading purpose, or I'm investing it for a long-term purpose. That is what we are saying. I'm investing in this financial asset as speculation. Speculation means I'm going to the stock exchange, for example, and let me say I go to the stock exchange, I purchase 1,000 shares at shillings 15, which means I have 15,000 that I'm going to invest in shares. But my intention of investing in these shares is that when the price of the shares increase, I'm just on a watchdog. I'm on a watchdog. If the price increase, for example, from 15 to 20, what do? I sell these shares, I get that profit. I'm just there for speculation. I'm for trading purpose. Therefore, I purchase. Now, when it comes to 20 times, that is times 20, that is 20,000. That is 20,000 now. Therefore, at that time, I am getting a profit. Let me say this because I'm getting the profit. Therefore, my work here is just speculation, just monitoring the market. How is it performing? Let me say this. Let me buy another share. How is it performing? I can get 1,000 there. Let me sell it. That can be one of my indention. That can be one of my indention. Number two indention, I can go to the stock exchange or to buy bonds or debentures in the market, but my indention is to put there my money. I put there my money for long term. For example, I want to file for MCA in 2027. I have some 1 million somewhere. I want to file for MCA in my village. Then what do? I can say, this 1 million, let me put it in bonds up to maybe 2027, up to maybe 2027. Therefore, my intention there is not to trade, is not to speculate. I'm putting their money, but my intention is for long term, for 3, 4, 5 years, so that when it comes to 5th year or the 6th year, I sell this instrument, I receive that money. Therefore, my intention is to put there, I can sell it at any time, but I'm not trading, I'm not speculating, but I can sell it at any time. We call it a fileable for sale financial instrument, a fileable for sale. I can sell it at any time, but not today, maybe tomorrow. I'm not for speculating purpose. Therefore, that in such a case, it will also inform me on how I'm going to classify this financial instrument. Number 3, let's go to cash flow characteristics. Let's go to cash flow characteristics. I can go to stock exchange, or I go to buy bonds and debentures. I buy bonds, that's government bonds or corporate bonds or debentures in the market. But let me say I have 10 million. I have 10 million. I want to invest 10 million. But that is the only money I have. That is the only money I have, for example. I'm just using an example for you to understand. Maybe that is the only money I have. Therefore, when I take it to the bonds or to the debentures, I agree with my customer that I'm giving you 10 million, but I want like this. Each year, you will be giving me the interest, part of the interest and the principal. Each year, you will be giving me part of the interest and the principal. Or probably each year, you will be giving me the interest alone. You will be paying me interest. At the end of the 5th year, then you give me back my money. Therefore, there, it is informing us about the cash flow characteristics. I'm giving you money, but you will be giving me something all along the way. Along the way, you are going to give me something. You are going to give me something so that at the end of the year, you give me back my principal, the nominal value that I invested in you. Therefore, that will inform us what is the contractual cash flow characteristics. Now, based on these two items, financial assets are classified into 3 categories. Financial instruments or financial assets are classified into 3 categories. Number 1, we call it financial asset at fair value through profit and loss. Financial asset at fair value through profit and loss. Financial asset at fair value through profit and loss. Number 2, financial asset at fair value through OCI. OCI means other comprehensive incomes. Financial asset at fair value through other comprehensive incomes. OCI means other comprehensive incomes. Financial assets at fair value through other comprehensive incomes or OCI. Then number 3, financial assets at amortized cost. Therefore, that is how I'm going to classify my financial assets and financial liability, financial assets in the market. Either I will call it my financial asset at fair value through profit and loss, financial asset at fair value through OCI, financial asset at amortized cost. Now, when we say financial asset at fair value through profit and loss, what does it mean? What does it mean? Example of this one is those instruments I'm putting for trading, for speculation, for short-term trading, for speculation purpose. Financial instrument for speculation purpose. For trading purpose, why am I saying it is financial instrument through profit and loss? It means that I'm going to the stock exchange, but for trading purpose. For trading purpose. For trading purpose. Therefore, any gain from the instrument, I report it as a profit in the P&L. Any gain from this instrument, I report it as a gain in P and L, in the profit and loss account. That is why we say this one is a short-term financial asset at fair value through profit and loss. It's a short-term instrument because it's for trading purpose, for speculation purpose. Therefore, any increase, like for example, I said I invested 15,000. After some 3 or 4 months, it is 20. Therefore, I co-sell, I get the profit of 2,000, there 5,000. I get the profit of 5,000. Therefore, that I will report it as a profit in the P, profit and loss account. Therefore, we are going to classify it because it's a short-term investment, maybe 1 year, 9 months, 1 year, like that. Therefore, my intention is to trade, to speculate. Therefore, any profit that I get, I report it as a profit in my profit and loss statement. When I go to the balance sheet, I'm going to report that instrument as a current asset because it's a short term. It's for trading purpose, it's a short term. Then we go to number 2, financial asset at fair value through other comprehensive income or OCI. Now, what will informers say that is an instrument that I'm putting to the market, but it is for long-term purpose, for long-term. For example, I said I want to stand for MCA in my village. I need money. I have 1 million today. I take it to the stock exchange. Then I say this money, I am keeping it to the stock exchange. I will withdraw it in 2027. Then I go to file for MCA. Therefore, what I'm saying here, that instrument, because it's for long term, any change in fair value, I'm going to report it as a comprehensive income, as OCI, as a comprehensive income, not the profit, as a comprehensive income. Are we together up to there? Yes, of course, we need to be together. I'm going to report it as income in my financial statement, as OCI. Any change in fair value. Because, of course, I will be valuing it at each reporting date. I put 1 million. At the end of the year, how much is my instrument? It's now 1.2. Oh, I have the profit of 200. Therefore, that 200, I need to report it in my books, but I'm not taking there as a profit. I take there as other comprehensive incomes. Then this is because I'm putting there as long term. At the end of the year, I will report it as a non-current asset. Why am I reporting as a non-current asset? Because it's there for long-term investment. Therefore, I report in my balance sheet as a long-term asset. Example of this is any equity instrument that is not for trading purpose. Any equity instrument that is not for trading purpose, or any instrument that is available for sale. Any instrument that is available for sale. Available for sale means that I'm not selling it today, but I can sell it at any time in future. Then we go to the last item, financial assets at amortized cost. Now, this will come in when we have the characteristics, the contractual cash flow characteristics of maybe I have specified debts of receiving either interest or some interest and part of the principal. I receive the interest and principal, or I only receive interest. At the end of the year, I dispose of the instrument, I receive my money. Therefore, if my cash flow characteristics is that way, then I will report it as financial asset at amortized cost, That is what informs the classification and measurement of this financial instrument. Now, let me come to another thing. I believe we have understood that. Let me now go deeper. If you have understood that, that is good. Waziri, have you understood what I have said? Waziri, you told me you come from, is it Lamu? That is good, Waziri. You told me that you come from as far as Lamu. Thank you very much for coming to us. And my phone iliisha bundles. Sorry for that. Sorry for that. Sorry for that, Florence. Sorry for that. Now let me come to another thing called transaction cost. Or before I go to transaction cost, let me go to financial liabilities. Let me go to financial liabilities. Let me go to financial liabilities. How do we classify financial liabilities? How do you classify financial liabilities? Now, financial liabilities are only classified into two categories. They are only classified into number one, a financial liability at fair value through profit and loss. Financial liability at fair value through profit and loss. Then number B or number two, financial liability at amortized cost. Financial liability at amortized cost. Therefore, that one is only classified into two. Financial assets are classified into three categories. That is financial assets at fair value through P&L, financial asset at fair value through OCI, then financial asset at amortized cost. But when we come to financial liabilities, we only classify them into two, fair value through profit and loss and at amortized cost, which means in liabilities we don't have what we call OCI. Therefore, that is the classification of this financial assets and financial liabilities. Now, let me come to a crucial item that I have already mentioned. We are coming to a crucial item called transaction cost. Transaction cost, these are the costs I'm incurring when I'm doing this investment. I will incur some cost, like I will give discounts, there will be issue costs, there will be transaction cost. When you are doing certain investment, of course, there will be some costs. Therefore, we call them transaction cost. Now, listen very carefully. If I'm investing, this is the critical point. This is now the critical point. Let me relax fast because it's very critical. Let me relax fast. Now, what I'm saying is, if I'm investing in an instrument, in the stock exchange, for example, and my intention is for trading purpose, therefore, I will classify it at fair value through profit and loss. Therefore, any transaction cost on this instrument, I'm going to take it directly to P&L as an expense. Any transaction cost, you charge it to P&L. any transaction cost if I'm classifying it at fair value through profit and loss, and there is any transaction cost, you charge it directly. You take it to P and L. Any transaction cost, you debit P and L, then you credit cash. You credit cash like that. Any transaction cost, therefore it means that any transaction cost, you don't add to the instrument, but you take it to P and L, any transaction cost. If we are classifying it as fair value through profit and loss. Now let me come to financial assets at fair value through OCI. My second category, financial asset at fair value through OCI. Now, if I'm classifying my asset, my investment as fair value through OCI, any transaction cost, add to the instrument. Add to the instrument. Any transaction cost, add to the instrument. Any transaction cost, add to the instrument. You add to the instrument. Like for example, I'm investing 20,000. I'm investing 20,000. That's my initial investment. But before I invest, I'm incurring 1,000 as costs, transport, blah, blah, costs, cost, brokerage fee, commission, those costs, 1,000. That 1,000, I'm going to add to the instrument. Therefore, the fair value of this instrument will not be 20, but 21. Therefore, any transaction cost, you add to the instrument. Any transaction cost, you add to the instrument. Therefore, we say any transaction cost, you debit financial assets, you debit, you credit cash. Any transaction cost, remember transaction cost, you are paying them. Therefore, any transaction cost, you add to the instrument. Then we come to financial asset at amortized cost. Now, amortized cost is a long-term asset because if it is amortized cost, these are like loans held to maturity, loans held to maturity, loans or bonds, debentures held to a specified period, maturity like 5 years, 4 years, like that. Therefore, any transaction cost, you are also going to add. Any transaction cost here, you add to the instrument. Any transaction cost, you add to the instrument. Any transaction cost, you add to the instrument. Now, let's come to financial liabilities. Let's come to financial liabilities. Let's come to financial liabilities. Now, in my financial liability, I have what we call the transaction cost. In my liability, I have what we call the transaction cost. Now, in the liability, the transaction cost, you subtract from the instrument. You subtract from the instrument. If there is any liability in that instrument, you subtract from the fair value of the instrument. Like, for example, I want to issue a bond, of 20 million, for example, 20 million. Then examiner tells me that the brokerage fee was 5,000 or 5 million. Brokerage fee, commission was 5 million. Therefore, here, I will less the commission of 5 million. Therefore, the fair value comes to 15. Fair value comes to 15. Therefore, if it's a financial liability, any transaction cost, you less. Any transaction cost, you less. But if it's an asset, we are going to check, is it a fair value through OCI or a fair value through profit and loss? If it is fair value through profit and loss, transaction cost, you take it to the P&L. If it is through OCI, transaction cost, you add to the instrument. If it is an asset at amortized cost, transaction cost, you add, of course, because it's a long term. That is what I wanted you to understand in that case. I wanted you to understand that in that case. Now, that said and done, I want us to look at one question. Let's look at one question. Let's have to look at one question. One question. Let's see, look at one question. Now, before we look at one question, because the question is just by the way, you need to understand the concept first. The question is just by the way. Now, remember, when the examiner is bringing these questions, listen very carefully. When examiner is bringing these questions, they look alike. You will wonder, is it a financial asset or a financial liability? Because the questions will be the same, but the way you report will be different. The questions will be the same. Now, how do you know that what examiner is asking is a financial asset? What examiner is asking is a financial liability. Now, listen very carefully. If the examiner tells you that ABC Limited issued a bond or a debenture or a loan instrument, ABC issued, then automatically this becomes a financial liability. It is a liability. If it is a liability, then it means that you are going to report the finance cost and the liability in your balance sheet. If it's a financial liability, what does it imply? You are going to report a liability and a finance cost in your financial statement. Or examiner tells you that ABC Limited borrowed. You borrowed, therefore it's also a liability, which means you are going to report what? You are going to report a finance cost and a liability at the end in your financial statement. But if examiner tells you that ABC Limited purchased an instrument, then automatically this becomes an asset to you. It becomes an asset to the company. If we purchased an asset, somebody issued, then we purchased. Therefore, for us, we invested, we gave out money, we invested. Therefore, here, in my books, I'm going to report what we call interest income, and net investment. I'm also going to report what we call net investment or investment in financial assets. Or examiner says ABC Limited acquired a debenture. We acquired a debenture. If I acquired a debenture, then automatically this is going to be a financial asset to the company. Or ABC Limited invested in a 5% bond, then automatically it is going to be a financial what? Asset. Therefore, you need to be very keen on this. Is it a liability or is it an asset? You need to be very, very keen. Is it a liability or is it an asset? You need to be very, very keen, because the way you are going to give us the figures, you are going to tell us, is it an income? Is it a liability? Is it an asset? That is what we require from you. Therefore, you need to understand, is it a financial liability or is it a financial asset? Now, let's go to the question of ACAST 2023. ACAST 2023, question number 4B. Question number 4. Let's go to the question of ACAST 2023, question 4. I think question number 4B or 4A. ACAST 2023, question number 4. Quickly. Also, let me open my link for past papers. I did not have mine here. The link for past papers. I'm just opening from our WhatsApp. The link for past papers. Then I go to ACAST 2023 quickly. ACAST 2023. Then I stop there at question number 4B. I stop there at question number 4B. Question number 4B. Question number 4B. It says like this. Question number 4B says like this. Waikwa Limited is a public limited company quoted on the Securities Exchange. The company's capital structure comprises both equity and debt financing. On 1st August 2019, the company raised additional finance by issuing a 24 million 4-year deep discount bond. Therefore, the company raised finance by issuing. Therefore, of course, if we issued, then definitely it's our liability. It's a liability to us. Therefore, in our books, I'm going to recognize what we call the finance cost and the liability. Then we go on. The interest is payable annually in arrears at the coupon interest rate of 6% per annum. The bonds were issued at a discount of 10% and were redeemable on 1st August 2023 at a premium of 1217 million. Sorry. The effective rate of interest was 12% per annum. The issue cost amounted to 1.2 million. The reporting date of Waikwa Limited is on that 1st July. Required, illustrate how the above financial instrument will be accounted for in the financial statement of Waikwa Limited for the years ended at 1st July 2020, 2021, 2022, and 2023. Round your answers to the nearest thousands. Therefore, here, we do the analysis of this question. Analysis. In our analysis, Waikwa Limited, that is the borrower. This person has no money. He borrows from people. The borrower. He don't have sufficient capital, therefore he wants to borrow. What will be the nominal value? Nominal value is the face value, 24 million. That is our 24 million bond. Then what is the coupon payment? Coupon payment. Now, coupon payment means this is 6%. Coupon payment is 6%. Coupon payment is 6%. Coupon payment is 6%. Now, the coupon payment means, listen very carefully, let me first write the effective interest. The effective interest is 12%. Now, what I'm saying here, coupon, what is the difference between the coupon payment and the effective interest? Now, the effective interest is the finance cost on the instrument, the market rate of interest on the instrument. But the coupon payment, that is the agreement between me and you. I'm saying that I'm giving you 24 million, but I will not just sit until 5 years or 4 years. You are going to give me something. That's what you are going to give me. We call it coupon payment. Coupon payment, the coupon interest. You are going to give me something. Although we are charging 12%, yes, we are Jakarta. We are charging 12%. That's the market rate of interest. But I will not just sit until the last year before I receive anything. You will be giving me 6% of the nominal value. Therefore, that is the difference between the coupon payment and the effective interest rate. Then we have the discount. We have discount. The discount is 10%. Discount, it means that although my face value of the bond is 24 million, but I want to motivate people to give me money faster. I want to motivate my good Florence and my good friend Edwin here, or Florence, to give me money faster. Therefore, I say, although I'm advertising 24 million, but for you, I'm giving you a discount of 10%. Therefore, you are not going to give me 24 million. Although in your books, you are going to report 24 million, but already you add the interest at that discount. Already you have the faida discount. Already you have faida discount. Therefore, we are issuing at a discount. Then also we have the premium. The premium of 1217,000. The premium 1217. The premium. Now the premium means when you will be coming to redeem, to pay this money back, you will not just bring 24. I'm giving you 24. but you will not pay 24. You will pay it at a premium, at above the par value. Therefore, you will pay it over and above 12 million, 1.2 over and above there, over and above. Therefore, let's look at this question. Now, the first thing we need to look at, we know that this one is a liability. This is a liability because we issued. It becomes a liability. Then we need the fair value of the instrument. How do you get the fair value of the instrument? How do you get the fair value of the instrument? The fair value, you take what we call the nominal value. Then you come and less any discount, you less any discount, you also less issue cost or transaction cost, then you get the fair value. You get the fair value. Like when we take in this question, the nominal value is 24 million. Discount is 10% of 24 million, which comes to 2,400. That is the discount. 10% of the nominal value. Then issue cost. Examiner told me that issue cost is, how much was the issue cost? Issue cost was 1,200. Issue cost is 1,200. Issue cost is 1,200. Thank you very much, not quitting. I said that you need to give me your exact name so that I know you. I know you very much. Therefore, I will take 24 million minus the discount, which is 2,400, minus 12. I'm getting 2,400. 2,400. That is the fair value. Suppose it was an asset to us. If it was an asset, the issue cost you add back. If it was an asset, listen very carefully because these things will confuse you maybe in an exam or when you are doing questions. If it was an asset, we have the issue cost, transaction cost, you add back. I already explained that. I'm not going back there. But because it's a liability, we said, if it's a financial liability, any issue cost, you less. Any issue cost, you less. Now, once you have the coupon payment, listen very carefully. Once you have the coupon payment, it means that you will be receiving something each year. You will be receiving something each year. If I will be receiving something each year, then I'm going to hold this asset at amortized cost over the period, at amortized cost. Because once we have the coupon payment, then it means you'll be receiving something. Therefore, you hold this instrument at amortized cost. Therefore, let's prepare the amortization schedule, so that we see how we are going to recognize it subsequent measurement. This is on initial recognition. On initial recognition, that is the fair value. When I go to subsequent measurement, I'm going to amortize, amortization schedule. Amortization schedule. Let me prepare the amortization schedule. I say here, principal balance, then interest, that is the effective interest, installment, then balance, carried down at the end of the year. Balance carried down. And we are doing for 4 years, therefore don't make it too long. We are doing it 4 years. We are doing it for 4 years. We are doing it for 4 years. I believe you are there. We are doing it for 4 years. We are doing it for 4 years. Now, in year 1, the fair value of the instrument is 2,400. That is the fair value. If there was no fair value, then we use the nominal value, 2,400. What is the interest? It's 12%. What is the coupon payment? 6%. Now, the coupon payment is always based on the nominal. The coupon payment is always based on the nominal value, but the interest, we base it on the principal balance. Therefore, what will be my interest? I will take 24 times. My interest is 2448. That is my interest, 2448. Interest is paid in arrears. Yes, it's paid in arrears. It's paid in arrears. That is why we are putting interest interest before after installment here, because we charge interest on the principal balance. If it was in advance, then you put the interest, the installment here, because we need to subtract. Therefore, this one is in arrears. This one is 6% times the nominal value 24 million times 24 million, which is 1440. We less, that is what we are paying out. Then what will be my balance at the end? My balance at the end will be 2400 plus 2448 minus 1440. I'm getting 2148. That is what I'm getting as the liability at the end. I come to year 2. I bring here 21,408. 12% of the opening balance. This one is constant. That one is constant. Installment, I'm saying, check on this line. Installment, I said, is on the nominal value. 6% of the nominal value. Check, I even drew the line on the nominal value. What was the nominal value? The nominal value is 24 million, 6% of 24 million. 6% of 24 million. You always, and I said you always calculate based on the nominal value. Therefore, the interest, finance cost, you charge it based on the opening balance. Based on the opening balance. What is 24? I'm saying 24, this one is the interest, the finance cost, the effective interest. We charge it based on the opening balance. I said based on the opening balance. Like here, the fair value is 2400. We take the fair value, this fair value, that is what we start with. Then we charge interest on the fair value. Then we come and subtract the installment, what we are paying out, which is 6% on the nominal value, on the face value of the bond. That is 12%. Remember this 12%. Then the second one is 12% times. That is 2569. 2569. I have rounded off. Examiner said that you round off to the nearest. Therefore, I have rounded off. 12% of the opening balance, 21, I'm getting 20, 2569. Then I take 21,408 plus 2569 minus 1440. 22,537. 22,537. That's my closing balance there. Balance carried down. Then I come to year 3. I bring 22,537. I charge 12% on this opening balance. How did you get balance brought down? This is the carried down. This is the carried down. What I'm saying, Florence, is when you are doing the amortization schedule, you begin with the principal balance brought down. And this is the fair value. If there is no fair value, you take the nominal value. I believe that one you have had. If there is no fair value, you take the nominal value, which was the face value of the bond. That one you have had. Then, because we are charging interest, we charge interest on the opening balance, Florence. You charge interest on the opening balance. Then this installment is what we are paying each year. Therefore, we remove it because we are paying. It is going out. Out of the interest, we are paying 14 what? Therefore, I take 20 opening balance plus the interest that we are charging to the instrument minus what I'm paying, I get the balance carried down. Then this balance carried down is what I start with in the next year. Then I again charge the interest on the opening balance, I subtract the installment, I get the balance carried down. Then I go to year 3. This at the end is what I bring here. Then I charge interest on it. Let me charge interest on 22 now. Times 1.2, I'm getting 2704. Then I subtract 1440. This is constant. That is constant. Therefore, I'm going to take 22,537 plus the interest, which is 2704, minus what I'm paying coupon payment, 1440. I get the balance at the end, which is 23,801. 23,801. Then I come to the year 4. That is my last year. That was a deep discount of 4 years. It was for 4 years. Therefore, I'm bringing the closing balance 23,801 there. I charge interest on this. Therefore, times 0.12, 2856. 2856. Now, this is the point you need to stop everything and listen. Now, listen to this. Listen, kindly listen very carefully here. I believe you are listening. Stop writing fast. Now, this is our last year. We are going to pay everything. This is our last year. We are going to pay everything. Our last year, we are going to pay everything. Then, how much are we going to pay? We are going to pay the nominal value of the bond, which equals to 24 million. We are going to return the people's money. We borrowed, therefore we are paying back. The time has lapsed, has expired. Therefore, I'm going to take 24 million plus the usual coupon payment of 1440. Then examiner told me that I will pay at a premium. I will pay at a premium. Therefore, I add the premium of 1217. We add the premium of 1217. We add, because examiner gave us the premium. If there's no premium, you don't force it. But here we have the premium. Therefore, we are going to pay the premium of 1217. This is the usual coupon payment. This is the people's money we took, 24 million. We are paying it at the end of the year 4. Therefore, how much am I going to pay total? I will take 24,000 plus 1440 plus 1217. 1217 is the question. Don't ask me, where did you get 1217? I just read in the question there was 1217 there, the premium on the repayment. Therefore, I'm getting 26,657. That is what I'm getting. That is what I'm getting there. That is what we are paying to complete this contract. Therefore, when you take this one plus this, you subtract this, you get 0. Yes, let me try. When I get 23 opening balance, 801, plus the interest, which is 2856, I'm getting 26,657. Of course, it becomes to 0. Because I'm clearing everything, it has come to 0. I have paid everything. There. Now, at this point, examiner will want you to show what goes to P and L. We prepare P and L extract, profit and loss extract. P and L extract. P and L, what goes to P and L as our finance cost? I have here 2020, 2021, 2022, 2023, 4 years. I have 4 years. I'm going to report finance cost. Finance cost is the interest we are charging in this one, the effective. Therefore, here is 2448, 25, 69, 2704, then 2856 there, 2856. That is the P&L extra, what we report in the P&L each year. Then I do the balance sheet statement of financial position, the balance sheet extract. What we report in the balance sheet, we call it balance sheet extract. Now I have the liability. This liability is what I'm going to report in my balance sheet. The liability in my balance sheet, therefore under financed by section, financed by, I have non-current liability. Non-current liability there. Of course, we have year 2020, 21, 22, 23. Those are our years. Each year we need to report. Therefore, non-current liability, I have what we call 6% bond. In the year 2020, I'm reporting 21,408. I'm taking it here from the statement there. 21,408. That is my current non-current liability in year 1. Year 2, that is 2021. It is 22,537. 2023, it is 2022. It is 23,801. Of course, 2023 is nothing. We put a dash in 2023 because there is none there. We have paid everything. We are going to pay everything. We have paid everything. There is no liability. This is what examiner will want you to report, to show. That is what the examiner will require. When the examiner says, show how to report, this is what you need to prepare. This one is just working. The amortization and everything is just working. Here you have shown how to report because you have told me that in year 1, my finance cost is 2448, what I have charged there. Year 2, it is this, year 3, year 4. Then what is the liability? You have shown me the liability. Therefore, that is how you prepare these instruments. And that becomes the end of our lesson today. God willing, we meet tomorrow. I have said, God willing, we meet tomorrow as we discuss more. Thank you for your time. Bye-bye. We meet tomorrow. Is installment an expense? Florence, I said that's not an expense. That is it is just part of the expense that you are paying. Part of the expense that you are paying. Therefore, it's not an expense that you are taking to P&L. It's only the interest, effective interest. This one is not an expense to P&L. You don't take this to a P&L. You don't take it to P&L. That's just the expense that you are paying. Part of this that you are paying. Tomorrow from 5, Waziri, tomorrow from 5 p.m. to 7 p.m., God willing. But we shall communicate. We shall communicate if there will be any changes. Thank you for your time. Bye-bye. Meet tomorrow.